The United States government spent approximately $882 billion in fiscal year 2024 solely on net interest outlays. This is not principal repayment. This is simply the cost of renting money. On this market report, we examine the mathematical inevitability facing the Federal Reserve. For decades, the conversation regarding U.S. debt has been political. Today, it is purely arithmetic. When the cost of servicing debt consumes 13% of total federal spending and approaches 3.0% of GDP, the policy options available to central bankers narrow to a single path. We are witnessing the convergence of two critical timelines: the compounding acceleration of sovereign interest payments and the structural limitations of tax receipts. This analysis will demonstrate why a Federal Reserve pivot is not a matter of choice, but of solvency, and why this specific dynamic positions gold not just as a commodity, but as the primary hedge against the debasement required to keep the system afloat. To understand the gravity of the current situation, we must look at the raw data from fiscal year 2024. Net interest outlays have risen by $223 billion from the previous year. To put this $882 billion figure into perspective, the U.S. government now spends more on servicing its debt than it does on its entire defense budget or Medicare. This creates a negative feedback loop often referred to as a debt spiral. When the Federal Reserve raised rates to combat inflation, they inadvertently increased the cost of the government's own debt. The Treasury must issue new debt to pay off maturing bonds, but now they must issue that new debt at significantly higher interest rates. Simultaneously, we observe the constraints on the revenue side. Tax receipts are a function of economic activity. If the Federal Reserve maintains high interest rates to suppress inflation, they restrict economic growth, which in turn suppresses tax revenue. We are left with a mathematical divergence. Expenses are compounding exponentially due to interest, while income is linear or contracting. There is no tax rate high enough to solve a spending problem of this magnitude without causing an economic depression. Therefore, the mathematics dictate that the debt cannot be paid back in real terms. It can only be paid back in nominal terms, through the issuance of new currency. This brings us to the Federal Reserve's dilemma. The central bank faces a binary choice. Option 1 is to maintain high rates to fight inflation, thereby pushing the U.S. government toward explicit default as interest payments consume the entire budget. Option 2 is to pivot, cut rates, and monetize the debt, effectively printing the difference. History and logic dictate that a sovereign nation that issues debt in its own currency will never voluntarily default. They will always choose inflation. This is the Fed pivot the market anticipates. It is effectively a surrender to the math. They must lower rates to make the debt serviceable, even if inflation is still running above their 2% target. This realization shifts the investment landscape entirely. We are moving from an era of return on capital to an era of return of capital. The objective is no longer simply growth. It is preservation of purchasing power against a currency supply that must expand to cover the $882 billion and growing interest bill. Now let us look at the asset class wars, housing versus metals. If we accept that currency debasement is the mathematical solution to the debt trap, the question becomes, where does capital hide? This leads us to the asset class war between residential real estate and precious metals. Conventionally, real estate is viewed as a definitive inflation hedge. However, in a sovereign debt crisis, the government seeks revenue aggressively. Real estate is an immobile asset. It cannot be moved, hidden, or transferred easily. It is subject to property taxes, which are reassessed annually. Consider the friction costs. Real estate requires insurance, maintenance, and property taxes. If inflation rises, the cost of repairs, lumber, labor, copper, rises with it. If local governments face budget shortfalls, property taxes rise. Therefore, real estate has a negative carry that accelerates during inflationary periods. You are effectively short the currency, but long the taxation and maintenance liability. Contrast this with gold. Gold has no counterparty risk. It has no yield, but crucially, it has no liability. It does not require a new roof. It cannot be reassessed for higher taxes simply by sitting in a vault. When we strip away the nominal price gains and look at net real returns, gold acts as a pure store of energy and value. In a scenario where the Federal Reserve is forced to monetize debt, causing the dollar to lose value, gold reprices explicitly to reflect that new money supply. It captures the inflation without capturing the associated carrying costs that plague real estate. The breaking of the $5,000 per ounce threshold, or any nominal high, is not a reflection of gold becoming expensive. It is a reflection of the denominator, the US dollar, becoming weaker. How do you positioning for the endgame? The data suggests we are entering a period of fiscal dominance. This means the Federal Reserve's monetary policy will be subservient to the Treasury's fiscal needs. They will print what is necessary to pay the interest. In this environment, the ultimate hedge is an asset that exists outside the financial system. While real estate serves a utility function, it is deeply integrated into the banking and tax system. Gold remains the only Tier 1 asset that is not simultaneously someone else's liability. The $882 billion interest payment is a signal that the mathematical limit has been reached. The pivot is not speculation. It is a mathematical requirement. The debt must be serviced, and the currency will be the release valve. As these capital flows shift, understanding the distinction between assets with liabilities and assets with pure value will define portfolio performance in the coming decade. Stay tuned for our next video, where we will continue to monitor these critical indicators. For more insights into precious metals and macroeconomics, subscribe to our channel. We are not a licensed financial advisor. The information in this video is for educational purposes only and should not be considered financial advice. Always do your own due diligence and consult a qualified advisor before making investment decisions.